Hey guys, welcome to a new video. In this video, we will be talking about inverse fair value gaps. Before we begin, please check out my previous video on fair value gap in order to understand the full concept. So let's begin. So what's an inverse fair value gap? An inverse fair value gap is basically a fair value gap that does not support price and the price closed below the fair value gap. For example, let's take a look at this fair value gap formed by this body. The candle then goes down and breaks through the fair value gap without any sign of it trying to retrace back, or it becomes a inverse fair value gap. So what could we do with that information with the inverse fair value gap? Inverse fair value gap creates a resistance and is a perfect way to take an entry. As you can see, this candle passed through the fair value gap without showing a sign of it trying to retrace back and closes below the fair value gap. This becomes a inverse fair value gap. And when the price retraces back into the inverse fair value gap, you could take an entry here. This is a level where there is a lot of resistance and is a good way to take an entry, as said. In order for inverse fair value gap to be valid, we have to look for fair value gap not respecting any of the price. We use this information to take an entry here. So in order for the inverse fair value gap to work, we are looking at the higher time frame, or anything on the higher time frame, it will work and respect it more. You have to mark out the 50% after a market displacement, which is right here, and cause a fair value gap to form. So what we want to see is the price draw back down and close below the 50% level. And to take an entry, the market comes back into this inverse fair value gap, we will be dropping down to the lower time frame, such as the 1 minute. As you can see, when we drop down to the 1 minute chart, you could see a lot of consolidation here when it's in the inverse fair value gap. This means that the price is holding, but we will not be taking an entry when the price is holding right now. And here you see the market break out of this formation, and as you can see here, you see a break of structure. So what do we do with that information? So if you're gonna mark out this high level to this low level and use a fair value gap entry here. So what could we do? We could go short, put the stops above the candle of the fair value gap, and target the low of the market, the low that the level has retraced back in. Or we could do is we could target the next low, which is right here. Both of these are good entries. To see is the fair value gap formed after a high or a low or a important level is hit in the market. Let's take a look at another example. Retraces back into the zone and later take out the fair value gap. Now this becomes a inverse fair value gap. So what do we do here? As soon as the price retraces back into the zone, we will be dropping down to the 1 minute time frame to look for a setup. So now we are on the 1 minute time frame of the exact spot where the market dips into the inverse fair value gap. You have to look for a break of structures, which is the break of high in this scenario. We will be using the Fibonacci retracement from the low to the place where the market start retracing back into the zone. You will be taking an entry with the fair value gap in this scenario. And we will be going long here and put our stops below the fair value gap, below this candle. Our take profits will be at the high level, or if you could target the next previous level as well. So let's go over a recap of what we just learned today. So what we want to see is a break of a important level, which is high or low, and see the market displace and creates a fair value gap. And what do you want to see? You see price not respecting the fair value gap and closes above the fair value gap. The fair value gap then becomes a inverse fair value gap when the price closes over the body of the fair value gap. This level is a support for your trades, but you need to wait for a drop to the zone, and you will be going into a lower time frame looking for a entry. On the lower time frame, you would then be looking for a break of structure of the market, and you'll be drawing out the Fibonacci levels of the bottom to the top of where it started to retrace back. In this case scenario, we will be using the fair value gap, but other stuff could work too, such as the breaker block, the aura block, or any other important level